There's the closing bell on Wall Street, and now it's market domination overtime. So I'm going to check on where the major averages ended the session here. We've got the Dow higher by about 318 points. That's about 0.7%. The S&P 500 up 0.9%, and the Nasdaq up about 1.5%. Most of the major averages rising in the beginning of the day and staying relatively steady throughout the course of the session. There have been some reports, as we've been talking throughout the day, from the Wall Street Journal that Tehran, Iran, was reaching out to Israel through channels saying that it wanted to perhaps negotiate on its various, the nuclear agreements that had been trying to come to with the U.S. as well. Nonetheless, still seeing tensions there continue and attacks there continue, but the market seems relatively optimistic about the situation, and crude oil also reacting as though there's not going to be a meaningful disruption to the flow of oil from Iran. We talked to Stephen Schork earlier in the program, longtime oil veteran analyst, and he said there is still a risk that we could see some kind of bigger conflagration there that would then cause a spike in oil prices. So still, we are watching that situation. We also continue to watch what's going on in stocks here and the big gains that we are seeing across the board. Now, some interesting movers here today. We had Meta gaining some 3% on the day, and that's after some reporting that WhatsApp will start to have ads on the platform. And if you look at now how Meta has done year to date, you're seeing it gain 20%, so up significantly from its lows of the year, and for a 20% gain overall. So that's one we've been watching closely. Likewise, NVIDIA gaining about 2% on the session, and there you're looking at a year-to-date gain as well. So up about 8% on the year and getting a little bit closer to those record highs where it was earlier in the year. So we're going to keep watching that one as well. Looking at the leaderboard, since we don't have Jared Blickery here today, I'm going to take a look. Risk on day. How do I know it's a risk on day? Well, ARK Innovation is the top performer on this leaderboard. That tends to be one that outperforms when there is this risk-on attitude. GBTC, Bitcoin, also semiconductors higher as well today. So those are some of the standouts to the upside that we have been seeing over the course of the session. Josh?
Thank you, Julie. Joining us now is Gargi Chaudhuri, Chief Investment and Portfolio Strategist at BlackRock. BlackRock is the world's largest asset manager with over $11.5 trillion in assets under management. Gargi, welcome, and always great to see you. So let's start with those geopolitical headlines, Gargi, because they were obviously front and center. Israel, Iran going red hot in the Middle East, but as Julie was just mentioning there, it was green across the screen today. It was risk on. What do you make as a longtime market watcher of that response, of that reaction? Does it make sense to you, Gargi? Do you think investors are being complacent? What do you think?
First of all, good afternoon, Julie and Josh. It's great to be back on here, and thank you again for having me. And, as you both were mentioning, I think there's a little bit of, both of the things that you mentioned are true. Number one, even before some of the de-escalation news that came out, that leaked out this morning with respect to Iran looking for ways to de-escalate, even before that, the markets had roughly stabilized if we looked at the price action overnight coming into this morning. And I think we were maybe looking at two things. Number one, that outside of massive left tail scenarios about Strait of Hormuz and that closing, outside of those tail risk scenarios that obviously would be really bad for oil prices, expectations were that this wouldn't necessarily be such a hit to consumption in the U.S., certainly not such a hit to oil prices moving meaningfully higher. And we have to remember that sort of energy as a percentage of disposable income has been declining. So all of those factors, I think, led investors to quickly focus on what else have we learned over the course of the last 2 weeks that are positive. Number one, benign inflation backdrop. Number two, a Fed that's going to continue to be patient, which is good for the time being. Number three, really strong, very solid AI earnings numbers continuing to come out every single week. And I would say that the market is going ahead and focusing on that for now.
Gargi, is the Fed's meeting this week a market-moving event? Is the dot plot going to be a market-moving event, do you think?
I think that they're going to try very hard to not be a market moving event this week. So my guess is that the bar for them to, obviously there's a lot of sell side notes out there that some are calling for the dot plots to show 2 cuts in 2025. Some are looking for 1. The bar for it to show only 1 cut is actually just two people moving their dots. So it's not that high, but I personally think that the Fed's going to try and give us the same message that they gave us approximately 6 weeks ago, because not that much has changed. If anything, things have changed in the slightly more positive direction, but not yet enough for them to signal a rate cut. So I think the best case scenario for them is retain optionality. It's way too early for them to either signal a rate cut in the September meeting or not to cut at all till December. So just have status quo. Talk about uncertainties that lie ahead. Talk about wait and see, which is obviously something that we heard from them last week. And I'd just say that when you're looking at the S&P projections that come out right at 2 p.m. and before the press conference starts, I would imagine that some of the movements in the growth and inflation projections for the end of this year will continue to move in that stagflationary direction. So get ready for that. Expect that growth will get revised down lower for at least this year, maybe even a little bit for next year, and inflation will more likely than not get moved a little bit higher. So let's us as investors get used to that. But as long as you're used to that, I would imagine that they're not looking to surprise the markets here. We have enough of those market moving events from elsewhere.
So if it's not the Fed, Gargi, as you look ahead now on your radar, what would be what are the potential catalysts for the market? Are we waiting for that big splashy trade deal, Gargi? Or am I waiting for the next earnings season? What do you think?
Yeah, so I think that we always, when we're looking for the next headline, we as investor community look for the negative headlines. I would say that actually I'm looking ahead for some of the positive headlines that can surprise us and continue this, this move in the S&P, this new bull market that we've entered into. So I think that, continuing to see softer than expected inflation prints. We saw that this week that maybe we sort of moved away from very quickly because of the geopolitical risk that followed soon after. But I'd expect to focus on that. I'd continue to focus on the incredible earnings season. By the way, Q1 was almost double of what was expected going in when we look at earnings growth. So continuing to focus on that, I would say continuing to look at what we get from the big, beautiful bill, that obviously we'll get more and more information on that. But anything that, again, removes the uncertainty from the market could be a potential for continued performance. And I'll also say this has been a great year for investors to think about allocating diversifiers in their portfolio. So I would say that this is a good time for investors to, yes, stay invested in what we think large cap quality companies, but really this is a good year to also add to international markets, to also add to things like gold and inflation-linked bonds as a way to keep that diversification alive.
So Gargi, diversification, hear you on that theme, which I know you guys have been talking a lot about really all year. But if we are looking on as the glass half full in U.S. equities, and we are potentially seeing more upside here, I guess I would ask, first of all, how much more upside? And what's the best way to play it within U.S. equities?
Yeah, absolutely. So, we think that we can probably continue to see large cap quality equities, and especially those specifically focused around the AI theme, continue to do well. I don't necessarily want to go out and say this is the level of the S&P 500 and this is the time at which we will get there, because none of us know what the next market moving headline is going to be. Which is exactly why that having diversifiers, having some front-end fixed income make a lot of sense in a portfolio. But if you maintain that high-quality equity portfolio with a focus on AI and at the same time sort of move away from the long-suffering, small-cap parts of the market that will probably, in our estimate, continue to suffer in a world in which profitability for those companies remains quite low, as well as rates remain high. So that remains challenged. We think that that could continue to be quite a driver of alpha in portfolios. And look, I'd also say that time and time again, we've learned that this is a market which is looking for a new micro narrative every single week. There's something or the other that we're all, as investors, focusing on. Getting used to that and maybe looking at dynamic strategies that are able to quickly rotate and adjust to those new realities, I think, are very helpful.
Gargi, good to see you as always. Thank you so much.
Thank you.
U.S. trade and tariff talks with the European Union and Canada are in focus as President Trump attends the G7 summit in Canada. For more on the latest, let's welcome in Yahoo Finance's Ben Werschkul. So, Ben, what are we learning? What are we seeing so far from the meetings there?
Yeah, sure, Julie. So we've got Donald Trump is in the Canadian Rockies today. This is where all these world leaders are gathering. And he started the day by saying that this summit, which is can encompass all issues, is primarily, in his mind at least, a trade-focused one. He's already met with Canada and Germany. He's had a welcoming session, an economic session. And then the newsiest bit will probably be in the next hour when he's meeting with the UK Prime Minister Keir Starmer, where they're trying to finalize the trade pact that was announced back in May. This was the deal in return for lowering of tariffs on UK autos. There's increased purchases, but the details were left up in the air, and they're trying to kind of nail those down so they can finalize that. Otherwise than that, though, there's a huge number of outstanding trade questions that the president is confronting this week. I would describe this meeting so far, at least, it's going to go into tomorrow, as sort of good vibes, but very few details so far. The meeting with the Canadian, Trump described it as fantastic, but we don't have any idea how they're going to reach a deal. Trump even described them as having kind of essentially two different worldviews on trade, and then saying that they're going to reach a deal. So that's the Canadian front. And then tomorrow there's going to be a lot of focus on the European Union side of this. We've seen a little bit of give there in terms of the UK accepting, or of the Europeans accepting what the UK has already accepted, which is a 10% floor, the kind of blanket tariff on all goods coming in. There's a signs that the European Union may accept that, even though they're still being negotiated and they're denying some of the specifics there. So that's the big issue that's coming up in the near term, because that's one of the first deadlines that's coming up. Trump's Liberation Day 2.0, which the European Union and a whole host of other nations would be part of, is only 3 weeks away from right now.
Ben, if you're one of these foreign leaders there and you're meeting with Trump, you're talking with Trump, what do you think you need to say to him, Ben, to help get a real deal done? What do you think Trump needs to hear?
I think what we've seen so far today is a lot of sort of praise for Trump. I think that's sort of why it's gone well. Big question coming in here was whether these meetings would kind of go off the rails, and we have not seen that yet, especially with the Canadian meeting. Trump came out of it describing it as fantastic, even though, to your larger point here, how they actually can kind of overcome these issues remains to be seen. So it's sort of, I think the outlook from these world leaders is to sort of set a good atmosphere and then hopefully be able to find concessions around this, even as Trump has sort of laid out some baselines. His 10% tariff is one he says he will not move on. Whether other countries can kind of flatter him enough to change any of those underlying dynamics remains to be seen.
Ben, thank you, sir. Appreciate it.
Sure thing.
Coming up, Hinge Health getting a boost today after some bullish Wall Street commentary. We're going to discuss the outlook for the recent IPO on the other side. Stick around. Much more market domination overtime. It's coming up.
Shares of Hinge Health, a digital physical therapy provider, getting a boost today after a slew of analysts initiated coverage of this company that recently went public. 13 different firms came out with a bullish outlook on Hinge Health. Joining us now is one of them, Scott Schoenhaus, KeyBank Capital Markets Managing Director and Equity Research Analyst. Now, for those not familiar with Hinge Health, it is a physical therapy virtual company. Now, we all know about all the virtual healthcare offerings over the last few years. This one's a little bit different. I almost think of it like, I think of Mirror, which is the sort of failed offering that Lululemon ended up buying, where you could work out virtually. like sort of as a little bit similar to this?
So Hinge is an app-based platform. The provider, the therapist, is the app themselves. Very much different from like a third party like Teladoc that was supposed to be an intermediary. So yes, you're correct in comparing it to that the device itself is the provider. How it's differentiated from a mirror, for example, is that you actually have real physical therapists guiding you, and there's an AI technology that is measuring 100 points on your body and actively telling you and encouraging you how to do the certain exercises or sessions in a very advanced technology. And then they also send out these devices that help you, that stimulate your nerves to help you ease the pain if you're in really chronic pain and can't complete exercises. So I would say it's a little more technologically advanced. The provider is actually a physical therapist. They're leveraging more and more AI to have leverage these physical therapists or care team members to an actual member. And that's led to really strong gross margins above 80%. So it's a really, really technology first platform.
Who would you consider their competitors, Scott? And what is their competitive advantage?
Yeah, the two main competitors are really Sword and Kaya. They're offering sort of digital MSK solutions.
MSK,
musculoskeletal, yes. So anything to do with your muscles, skeletons, joints, which is the largest spending in healthcare for America, outspends diabetes and cardiovascular.
Wow.
So huge market. But those solutions, for example, send you a tablet. It's not on your phone. They don't have the technology, the 3D technology like we talked about to measure the 100 points on your body. They don't have these Enso devices. They are not in network with all these health plans in the way that Hinge has done over the last several years, which I think is a really strong competitive moat that these health plans actually want to use the platform. So they're really seeing hard dollar ROI. This is something we highlighted in our report this morning. Just looking at PT, in-person PT, not even going down the route of back surgeries, which can be very expensive. A PT session is usually $120 per session. You're usually supposed to go 2 times a week over 8 weeks. That can get to almost $2,000. The Hinge cost to your employer is somewhere between $900 and $1,000 per year.
Well, I was going to say, though, I mean, when you talk about competition, isn't the biggest competition going to a physical therapist, right? I mean, so how does something like Hinge Health convince more people to, because as you say, part of it, I guess, is convincing the employer health plan. There, from a cost perspective, it's probably an easy sell. But if I'm an individual and I want that, in-person effect, that might be tougher.
Yeah, so as someone who actually has had physical therapy, in-person physical therapy, I know the struggle of getting someone that's in your network, and then if you have a high deductible plan, you are paying that deductible right at the your first several appointments, could be thousands of dollars. Hinge is really a user-friendly, no cost to the actual user, the employee. Your employer pays all the cost. They send you all the technology equipment that you need to put your phone up, a mat. They send you this Enso device that we talked about. So they are trying to get people engaged on the platform in a very user-friendly and seamless way that avoids all the pains of going to an in-person physical therapist. You have to take off time. I mean, it can be a cumbersome process just to even find a physical therapist that's in your network that will be covered by your insurance provider.
So Scott, as we mentioned, all 13 analysts on the street, by the way, have a buy on this name.
Yeah.
13 buys, no holds, no sells. When you're talking to your clients and they ask you, Scott, okay, what are some of the risks I need to think about with this name? What would you tell them?
Well, they are clearly moving towards a more utilization-based model, meaning it's not going to be an upfront revenue type model. They're going to be charging the employer a $55 per member per session fee. And so when we're talking to tech investors, for example, that's some of the fear that they have. Can they get utilization up to drive revenue growth that's forecasted above 20%? We actually put this in our report. We're measuring app data, and since the start of the year even, we've seen sessions per member per month go from about 9 sessions per member per month to about 13. So we're clearly seeing them drive traction on the platform already.
Scott, great to see you today.
Thank you so much for having me.
All right, time now for what to watch. Tuesday, June 17th. Going to start off on the economy. We're going to be getting monthly U.S. retail sales data for May in the morning. Economists forecasting total sales to fall 0.6%, signaling that consumers are buying less amid elevated interest rates and tariff uncertainty.
Moving over to housing, the monthly homebuilder confidence index for June coming out in the morning. That number expected to rise from May's number to 36. That would suggest builders are feeling slightly more optimistic about the housing market, but the number would still indicate that builders are pessimistic overall.
And on the earnings front, Lazy Boy announcing results for the fourth quarter after the markets close. Analysts expecting the furniture company to post $558 million in revenue with adjusted earnings per share of 93 cents in Q4. Lazy Boy's annual revenue has declined 8% over the last 2 years, highlighting potential issues with market positioning amid a challenging economic landscape.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.